Good morning. Welcome to Stock Market. Today, it's Monday, September 21st, 2020. This is your host, Dan Russo, Chief Market Strategist at Retaken Analytics. Find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Retaken Analytics. Head over to RetakenAnalytics.com/today. Sign up for a free email where I get a lot of the great content for this show. Also give you daily stock ideas to consider. And that hits your inbox every trading day before the market opens. So let's dig into it now. Hope everybody had a great weekend, but it's Monday morning. Back at it. U.S. equities lower in Friday's trading, though finished off the worst levels of the day. S&P and the NASDAQ down for a third consecutive week. Treasuries were little changed. The dollar was down on the yen cross, little changed against the euro and stronger against sterling. Gold finished up 60 basis points. WTI crude was up 30 basis points. Drilling down at the sector level, all sectors were lower on the day, with the bond proxies performing the worst. REITs and utilities, big underperformers. Healthcare and financials outperformed on the day, but as I said, all sectors lower on the final trading day of the week last week. And as we get to the desk this morning, S&P futures down about 1.8% and trading near their worst levels of the morning. Asian markets were lower overnight. Hong Kong, big decliner, down over 2%. Japan was closed for a holiday. European markets are under pressure as well. A lot of the major markets across the pond down about 2.5%, with the banks and the travel names among the worst performers. Some potential lockdown fears there. Treasuries are unchanged to stronger at the back end of the curve this morning. The dollar is stronger against the euro and sterling, but weaker against the yen, which makes sense. The yen is a safe haven asset. Gold down 1.1%, crude oil down 2% to kick us off on a Monday morning that have the major averages. Well, S&P and the Qs start the week below those key support levels. We've been talking about it, right? 3,400 for the S&P 500, Qs 270. Not a good look. Not a good look for the two main markets. What I've done here this morning is said, okay, now that we're below these levels, we know that the risk to the downside is elevated, right? If you're running, the ever-changing game of probabilities in your head, below 3,400 on the S&P 500 increases the odds that we go to 3,250. And if we go below that, where could we think about? Well, the key retracement levels, a 38% retracement of the entire advance off the March lows gets you back to 3,050. A 50% retracement gets you back to about, just under 2,900. So this is how you have to be thinking about it. Below 3,400, what's most likely to happen? 3,250. Should we go below that? Now you got to start to think about it. The point is, you're not trying to catch the knife here. You're looking for the market to show some signs of stabilization now before getting aggressive on the long side. Today's the day. I have no idea. Nobody does. Okay? But I don't want to buy the Qs on their way down. I want to buy them on their way up, right? Last week, they were looking like they were holding 270. I thought they picked up. They look compelling as a trade to the top side, but now they've broken. So you get out of the way. It's pretty simple, right? Risk a little to try to make more. Qs has room to 250 if 270 is not retaken. IWM is the last market standing. Defending 150 would be important here. IWM under some pressure here today. So there's the framework, folks. For those of you who read my note a week and a half ago, and even last Sunday, the note that I wrote, I laid out a roadmap. If this, then that. Well, run through those scenarios in your head. I've been doing them for you every day here. Under 3,400, you're managing risk. That's it. That simple. Q's under 270, you're managing risk further. Should IWM give way? You're getting out of the way. That's it. Manage your risk. If your stops are being taken, take them. You should be naturally raising cash in this environment. And then when market shows signs of stabilization, you'll have cash to deploy. It's not about calling the top or the bottom. It's about assessing the odds every minute of every day. Let's hit our market in a minute now. What are we writing about in the note to clients? Well, 3 straight losing weeks for the SPY and the Qs is important support breaks. We hit on that. The gold consolidation continues, and we're watching for a directional break here. And I think the dollar could be the key gauge of the next move in all markets. We'll talk about what that means a little bit later on. But, if you're bullish commodities as we have been, if the dollar starts to rip higher in a risk-off type trade, everything's going to get hit. right? So watch the dollar here closely. If the dollar breaks out of this consolidation to the upside, you have to figure lower equities, you have to figure lower commodities. And then the question from there is, do support levels hold? What happens? Treasuries could be the wild card just given rates are pinned. We'll have to see how that plays out. Let's hit our major indices from a power bar perspective. You've seen the deterioration over the course of the past 2 weeks. For those of you who are paying close attention to these numbers, the ratios are just deteriorating. There's no two ways about it. The Dow was down 85 basis points on Friday, 42 bulls to bears there. S&P 500, 114 to 90 bulls to bears. Look at the NASDAQ, almost back to even after losing 1.3% on Friday. Small caps outperformer on the day, though they were lower. 637 to 283 bulls to bears there. Bonds down, tick, sending yields slightly higher. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major indexes across the board, however, are mixed. Stock of the day is a play on a theme that we like. Mosaic is a play on ag, which is a play on inflation. So you see how that works. We started talking about rising inflation potential back in the late June, early July timeframe when we started talking early about the outperformance of materials, right? We've loved gold for well over a year. Let's get that out of the way. And then we started looking at material stocks. They started to outperform. So we liked material stocks back at the end of June and early July, right? And then the natural progression from there has been to drill down, right? And then it's all part of this rising inflation theme as the dollar weakened, our view of stagflation, right? No growth, but rising inflation due to fiscal stimulus. That's largely playing out. We could be at an inflection point with the dollar here right now. We'll look at that a little bit later on the show. But now we're starting. So the next progression is the ags, right? The DBA, the ag commodities are starting to pick up. So we look for stocks that could be a potential play on that theme, and Mosaic is one of them. It's a fertilizer company. So this is a compelling setup to me. It's a bullish stock. It's outperforming, bullish money flow, rounding out of an oversold position above the rising long-term trend line. Now, obviously, the market is spotty. So you have to decide how aggressive you are with your portfolio. I think it's an interesting theme. I'm fully aware of the fact that with the market spotty, and if 3250 breaks, stops are going to be triggered, and that's fine. But thematically within this these trends that we've been talking about, the ag names become the next progression, in my opinion. For those wishing to play that theme through other products, you can. There are individual ETFs that track agricultural commodities like wheat, corn, cocoa, coffee. You can start to take a look at those charts and see which ones look compelling to you. But Mosaic is a fertilizer play. Soybeans I left out. They've been an absolute monster. Mosaic is the fertilizer play on that. Let's touch on our market sector tracker now. Movement over the last 5 days. Energy, counter trend rebound. I am not a fan. Oil rolling over. Industrials and materials, our two favorite cyclicals, continuing to outperform. Healthcare REITs round out the groups that are higher over the past 5 days. Fins, Utes, and TAC are middle of the road. Discretionary staples and comms, bottom of the list. So a lot of the same themes playing out here. And it's just, it's pressure is building. That's how I see it. The pressure is building in the market. And we're not going to catch it. I'm sorry. I'm not going to stand here and say you should buy it now and watch them go down another percent, right? Let's wait for some signs of stabilization now that key levels have broken. For those of you who like to stay invested, well, then you're rotating to the outperformance. And that is a different story. The industrials, the materials, right? The stuff that we've been talking about still makes a ton of sense because what you're trying to do is stay invested to the best you can, lose less as the market is going down, and then be positioned to outperform on the way back up. That's a longer term time frame, longer term mindset, and I love it. Absolutely love it. I invest a large part of my portfolio that way. I'm not going to make the call all in, all out. I'm just going to skirt to the outperformance, and over time, I should come out, hopefully, if I'm disciplined, way ahead. Let's look at our industry and focus now. Retail services over the past 6 months, monster outperformer, 41%. Power bar ratio, future potential, 33 to 7 bulls to bears. Number 5 of 21 subsectors. Names like Zoomies, Big Lots, and Lithium Motors, all with very bullish Chaikin power gauge ratings as we dive into the XRT, which is consolidating after making a new 52-week high. It's oversold. It's an outperformer. What's amazing to me here is that everybody's left these REITs for dead, and they're working. And we can't even pin anything on Amazon here. This is the equally weighted ETF, right? So it's broad-based strength in the retail space. Thank you, Fed. Thank you, Congress. Thank you for giving everybody free money, right? We're just going to take that money and spend it. That's what we do. This is America. The consumer is a massive portion of the economy, right? So Fed prints money, Congress gives it to you for free. What do you do with it? You spend it, right? So here's your retail trade. This is why the next round of fiscal stimulus is so captivating and everybody's paying such close attention to it, right? And it's literally keeping the economy together at this point, or a big chunk of what's keeping the economy together. So something to keep in mind here for this group that's very bullish and still outperforming and in a strong trend. Next round of stimulus likely juices the market, with this group likely being a big outperformer. Let's look at our trending names now. Friday's movers and shakers. APTV had their price target get taken up at Morgan Stanley. Newsay, nothing company specific there. STE, one of these medical tech name that just goes on to consistently make new all-time highs, up 2.5%. FLT, an M&A deal, sent that stock higher. Dollar Gen, no real news there, up 2.15%. Loser side of the board, not a ton of company-specific news. H&R Block, didn't see anything there. Norwegian, down 5.8%. Carnival down 5.75%. Carnival did an equity offering, at which point they updated their guidance lower and announced further cancellations into 2021. So weighing on the group. And then now we have potential lockdown fears as cases are spiking in Europe. That could lead to further pressure on these names. Peak, no real news there. VNO, didn't see anything company specific. Did see that they got a mention in Barron's over the weekend, but I did not see the article. Let's look at the charts now. Gold consolidation. We touched on equities already. You know how I feel on equities. Let's look at the bigger picture here. All right, let's think of the framework. Gold is consolidating, and it's been a monster. We've loved gold for well over a year. This consolidation is playing out as the RSI holds bullish ranges. So I think we're just kind of watching here and playing for the next break. Odds favor an upside resolution, but that's not guaranteed. So if you're long gold and you've just been riding this consolidation, a break down takes you out of the trade. A break up, maybe you add to it or maybe just continue to ride it. But I think the dollar is going to be really important here. Obviously, there's an inverse correlation between commodities and the dollar, as global commodities are priced in US dollars. Dollar strength, weaker commodities for the most part from a trend perspective. You can see it here. I mean, here's gold ripping higher as the dollar has trended lower. I mean, it's you can see it. The correlation is there, right? It's well understood at this point. So if fears of further pressure on markets cause a flight to safety into the US dollar, the commodities are going to get hit in the near term. There's no two ways about it. You watch this consolidation and you'll then potentially look for a level that keeps the trend intact, which is why we're going to drill down on the dollar here and say that it's kind of important here. Here's the USD, the dollar index. Here's your decline, right? Shift in momentum to the downside. Now at these lows, as we've made lower lows through August and September, we've made higher lows for the RSI. That's a bullish divergence that now awaits a confirmation. What would constitute a confirmation? Well, to me, near-term confirmation would be getting above the 50-day moving average, which roughly coincides with the top of this consolidation range. And then you can start to think about where we're going from there. 200-day moving average up here at 97. That's it, folks. You see that this dollar break higher, your commodity exposure should start to come down. Your equity exposure will likely come down as well. So I think I remember the charts from last week, copper, gold, right? We talked about things being at inflection points. It's across the board. It's global. The inflection points are global, and the way they break could have massive implications. And I think that that's what everybody's kind of sitting on their hands and watching. The equity story is only part of the game. There's massive global implications across asset classes. I mean, here, another one, just going sideways. Look at the 10-year yield, just going sideways here, just below 70 basis points, sideways. Which way is it going to go? We don't know. But a bet lower here would likely coincide with fear in the marketplace. So it's just something to keep in mind. Take us for a test drive. I'm going to wrap it here. ChakinAnalytics.com test drive, free 14-day trial. You get my note every day. Have a great Monday, everyone.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.